BestBookBits.com presents The Bogglehead's Guide to Investing by Mel Lindaya, Michael LeBeouf, and Taylor Laymore. The Bogglehead's Guide to Investing is slightly irreverent, straightforward guide to investing for everyone. The book offers sound, practical advice no matter what your age or net worth. Bottom line, become a bogglehead and prosper. An easy-to-use, need-to-know, no-frills guide to building up your own financial well-being so you can worry less and profit more from the investments you make. Invest like a bogglehead and let their grassroots investment wisdom guide you down the path of long-term wealth creation and happiness without all the worries and fuss of stock pickers and day traders. If you face a financial crisis or problem, or simply want to know what is prudent to do with the money you save, the Boggleheads will have the answers you need to help you gain your financial footing and keep it. The written summary can be found on our website, bestbookbits.com. So without further ado, I bring you the book summary of The Bogglehead's Guide to Investing. Choose a sound financial lifestyle. Number 1, borrowers borrow money from the future in the form of credit loans till the lifestyle collapses. Consumers consume money paycheck to paycheck. Keepers focus on accumulating wealth over time. Number 2, the focus on net worth mentality over paycheck mentality strongly works in keepers' favor. Start early and invest regularly. Number 1, compounding is the key to building wealth. Compounding is the key to building wealth. People who save and invest early on gets a huge advantage. Know what you are buying. Number 1, stocks represent ownership in a corporation. Number 2, bonds are equivalent of lending money to a corporation who returns you interest on that until it finally pays you the original value. Short-term bonds, 1 year. Intermediate term, 2 to 10 years. And long-term, 10 years or more. Number 3, treasury bonds can be purchased directly from treasurydirect.gov. Series 1 and TIPS are recommended as inflation-protected bonds. And number 4, municipal bonds are state and federal tax exempt. 5, bond funds are a collection of bonds with varying maturity dates. The weighted average maturity of them is called duration. A bond fund with duration of 4 years is expected to lose about 4% its value if interest rates go up by 1%. Number 6, bond fund, short term 1 year to 4 year maturity, intermediate term 4 to 10 years maturity, and long term 10 year or more maturity. Number 7, a 27-year-old should hold 27% of net investments in bonds. Number 8, mutual funds buy securities, equities, bonds, or could be hybrid. Number 9, fund of funds buy other mutual funds. Famous fund of fund is Vanguard Life Strategy Funds. And number 10, mutual funds are priced at the end of the day based on the value of equities, bonds they hold. Number 11, annuities combined insurance with investment. Mixing the two is a bad idea. Therefore, people are better off considering things like 401k, IRA, etc. rather than annuities. And number 12, ETFs are like mutual funds, but they are traded continuously in the market, which means they can be valued at higher or lower than the value of underlying securities. Protecting against inflation. Number 1, inflation erodes the real value of money over time. Number 2, Series 1 bonds having an inflation component. They are bought and sold directly from US Treasury. Number 3, TIPS rates are controlled by market. The only way to guarantee no loss of principal is to buy them in treasury auctions. Holding them in a taxable account is bad since inflation adjustment produces taxable phantom income. Since TIPS are market traded, they must be held to maturity to guarantee no loss of principal. Unlike bonds, which have to held over a period of 1 year. How much do you need to save? This chapter referenced some calculations which take numbers like future inflation rate, future returns rate after a person turns 65. I think those numbers are just too varied to have any certainty on deciding how much to save. Keep investments simple. Number 1, in rest of our life, we try to be better than the average. Go with guts and take an action when crisis happens. All these are bad for investing. Number 2, best option is to buy index funds which track a particular index. Buy one with low expense ratios, since in the market you will get what you don't pay for. Number 3, a lot of actively managed funds have good pre-tax but bad after-tax returns since they trade heavily, high turnover, and pass the realized gains to investors. Asset allocation. Number 1, time and again, various studies have shown that experts cannot predict market. Number 2, a study showed that among 4 factors, asset allocation of stocks, bonds and cash, individual security selection, market timing and cost, 93.6% returns were controlled by asset allocation. Active management led to a reduction of 1.1% in returns. Number 3, another study by Vanguard showed that 77% of variability of fund returns were determined by asset allocation. And number 4, for large domestic stocks, returns between 1935 to 2013 varied between minus 43% to plus 54% for 1 year period, minus 1% to plus 20% for a 10-year period. Number 5, risk tolerance is an important consideration. When market crashes, all experts say that worse is yet to come, and if that fear can lead you to selling, then you are better off with a more conservative bond-focused portfolio. And number 6, international stock allocations should be about 20 to 40% of the portfolio. And 7, high-yield bonds, junk bonds, are speculative and not worth the risk. Given that yields are tax ineffective, people should buy safer bonds instead. Cost matter. Number 1, from front-end sales commission, deferred sales charge, back-end loads, purchase fee, exchange fee, 12B1 fee, and several other such fees are charged irrespective of how the fund performs. Number 2, funds with higher turnover produce bad after-tax returns. And number 3, always try to invest in lower cost funds. Taxes. Number 1, stock dividends are taxed at a lower rate than regular income. Bond dividends are taxed at regular income. Long-term capital gains are taxed at a lower rate. And unrealized gain losses are taxed only on realization. Focus on tax-efficient placement. Tax-managed funds try to focus on improving after-tax returns. Tax loss harvesting uses short-term losses to reduce tax liabilities. If you have to buy bonds in your taxable account, buy either Munis or US Saving Bonds, Series 1 or Series EE. Retirement accounts. Always buy mutual funds after their distribution date. And last, sell profitable shares after year end to delay tax payments for a year. Diversification. Diversification reduces the risk of being overexposed to certain sectors. The best diversification is to hold the entire market. Performance chasing and market timing. Number 1, best performance of the past have no correlation with the best performance of the future. Worst performance in the past have some correlation with bad performance in the future. Number 2, time and again, public contests held for timing the market have shown that no one can time the stock market. All those 3 stocks to own now are pure bullshit. And number 3, predicting interest rates to time the bond market is equally harder. And 4, inactivity strikes us as intelligent behavior. Warren Buffett. Investing for college. UTMA and UGMA are bad accounts since children can do anything with them once they turn 18. Number 2, saving bonds 1 or EE are good since their earnings are tax-free if used for educational purposes. And 3, Coverdell ESA have annual contribution limit of $2,000 after-tax contribution, and tax-free growth, if used for educational purpose, can be contributed only till the child is not 18 and must be used before the child turns 30, or can be transferred to another child after that. And number 4, 529 plans allow much larger contributions, 5 times the annual gift tax limit once every 5 years. The growth is tax deferred and withdrawals tax-free if used for educational purposes. There is 529 prepaid tuition plan as well, which allows one to pay tuition at current rate for a state college or university. Managing a windfall. Inheritance, real estate sale, lottery are difficult to manage. The first step one should take is to deposit it somewhere and leave it for 6 months. Then make a wish list of short, intermediate, and long-term goals and get professional help to manage it. Financial advisor. If you're planning to have one, go for one with a CFA/CFP title. Go for fee-only advisors, not fee-based or anything else, since they are paid by no one except you. And number 2, one-time fee or hourly rate is another good arrangement. Rebalance. Number 1, as asset allocation goes out of aligned limits, rebalance. And number 2, rebalancing can be time-based. Once every 18 months is best, or event-based if portfolio diverts by more than 5%, then rebalance. Tune out the noise. All forecasting and get-rich-quick schemes are noise. Behavioral economics. Number 1, recency bias. If market has done bad in past 1 year, we believe the same for the next one. Number 2, overconfidence. 70% of Americans believe they are above average. The same gets reflected in decisions about investing. Number 3, loss aversion. We feel pain of loss of $100 twice as much as we feel the gain of $100. We feel the pain of loss of $100 twice as much as we feel the gain of $100. And number 4, paralysis by analysis. Too many choices of funds to invest in confuses us. And number 5, endowment effect. Feeling safer and overrating what we already own. Number 6, following the herd. It makes us feel safe to buy what everyone else is buying. 7, mental accounting. It's the habit of treating money coming from different sources as different. And 8, anchoring. Holding on to investments who have badly lost its value and might never recover just because we are anchored to its past price. And number 9, financial negligence. Being preoccupied with other things in life is no reason to ignore finances. Spending in retirement. Number 1, better underspend than overspend and run out of money in retirement. Number 2, keep fixed living expenses as low as possible. Number 3, have a viable way to earn income if needed. 4, don't take Social Security paychecks till the age of 70. And 5, annuity could be good for people older than 75. And number 6, a safe withdrawal rate is 4% of initial value or 5% of current value portfolio. Insurance. Number 1, disability insurance is more important than life insurance. Number 2, buy insurance if downsides are huge, even as chances are low, e.g. flood insurance. And number 3, buying insurance for narrow things like specific diseases is a bad idea. Number 4, cheapest insurance is always self-insurance. 5, carry largest affordable deduction. 6, cash value insurance like universal insurance is a bad idea since it mixes insurance and investing. It's best to keep the two separate. Number 7, rather than life insurance, prefer buying term insurance. 8, if your employer offers, consider HDHP for health insurance. And number 9, illness and medical bills cause 50% bankruptcies. Illness and medical bills cause 50% bankruptcies. An umbrella policy of $1 million is a good idea to deal with potential litigations. And number 11, if over 50, give serious consideration to buying long-term care before turning 60, since 60% of the population will require nursing home stays. Inheritance. Number 1, currently up to $5 million is tax exempt from inheritance. And 2, will takes care of passing on the assets, else they will be stuck in probate, which can be lengthy and expensive. Number 3, living trust makes the process much more smoother. Transfer assets to trust. Make yourself and your spouse co-trust and children successor trustee. And 4, power of attorney for finances and for healthcare is a good idea as well. They become active only if the person is incapacitated and unable to make decisions for oneself. And number 5, charitable trust is another option for donations to charities with better tax treatment. And that's a wrap on the Bogglehead's Guide to Investing. Subscribe to our channel and take a look at the hundreds of book summaries uploaded previously. And to find hundreds of written summaries, check out our website, bestbookbits.com. And for hundreds of audio podcast summaries, find us on mixcloud.com/bestbookbits. Like and share if you got something from this summary, and comment on what one thing stood out for you. Thanks for watching and have yourself an amazing day. Take care.